You guys ready?
Yep.
Okay. All right, so today it's pretty straightforward. We're just going to play about the first hour and a half on the new material from chapter 12, then the quiz for that particular chapter from around 9:30 to 10, and then test number 2 from 10 until noon. Okay? All right, so one of the big topics of today is financial leverage. So how many of you have heard that term before? Yes? Okay. So any idea what it means? I mean, if you had to just simply explain to somebody in a sentence or two what financial leverage is, how would you explain it?
The power of financing, using somebody else's
Okay.
money.
Yeah.
Using somebody else's money, the power of financing. Okay. That's all good. In essence, what you're doing in most cases with financial leverage is that you're borrowing money from someone else at a lower cost than what the project is returning. Okay? If you had no debt on a project and that project simply had a 10% rate of return, okay, has a 10% rate of return, and that's assuming an all equity transaction, no debt, then simply your rate of return as the equity investor is simply 10%, okay? Now, whenever we introduce debt into the equation or borrowing other people's money, the key in this particular scenario is we want to borrow at a rate something less than 10%, okay? In other words, the cost of borrowing needs to be something less than 10% or equal to, okay? If it's equal to, in other words, if we borrow money at 10% and the project is returning 10%, we're not getting any financial leverage, okay? It's just simply we're getting the same return, okay? But if we borrow money at less than 10%, we're going to be generating positive financial leverage.
Is it equal or less, or just
Well, really less than.
less?
Okay, if we want to get any form of leverage. Okay, we're not getting any leverage at all if it's equal, okay? But below 10%, we're going to be generating positive financial leverage. That's a good thing, okay? That means that we're going to be earning not only whatever our rate of return is, but we're going to be earning more because of the cost of debt being something less than the overall project return. And I'm going to show you a little formula to kind of help to conceptualize this in a minute. Right now, just trying to help get your head wrapped around this. If we borrow at a cost of borrowing greater than 10%, we're still going to have financial leverage, but it's going to be negative, okay? And that's a bad thing, because there, the cost of borrowing is greater than the return that we're getting. So we're, in essence, we're going to be losing money, okay? All right, does that make sense conceptually? Everybody cool with that? All right, now, a simple formula for this is sort of the overall project return is equal to, we're going to sort of break this into two parts. We're going to have the debt piece, our debt piece, and our equity piece. Okay? Over here on the debt piece, the first half of this is going to be our loan to value ratio, and then over here is going to be our cost of debt. And both of these are going to be expressed as a percentage. on the equity side, basically the same sort of thing, but here we're going to be looking at, in essence, what is the equity or percent equity that we put into the deal, and then our return on equity. Okay? Really simple formula, and we're going to try to work through several different examples and give you kind of the idea of what we're talking about. So let's just say that we start off with that project return of 10%. Okay? Now, you tell me, all right, what sort of loan-to-value ratio do we want on this particular investment? 90%. Okay? Well, implicit within this, if our loan-to-value ratio is 90%, what percent equity are we putting in? 10%. So 10% is going to go over here under the equity. Okay? So far so good. Okay? Now, what is our cost of debt? Cost of debt meaning, in other words, what is the interest rate that we're borrowing at? Okay, so give me an interest rate. 7%. Okay, so before we go any further, are we going to get financial leverage on this deal? Yes. Is it going to be positive or is it going to be negative? Positive. Because, as we were talking about earlier, our cost of debt is less than our overall project return. Okay? So now what we're going to do is we're going to solve for our return on equity. Now here's the thing. With this little formula, you've in essence got 5 different variables. Okay? I should be able to give you any of those 4 variables and you should be able to solve for the 5th. Does that make sense? And just in terms of the basic math. Okay? So what I typically do whenever I approach this is I simply start out and do whatever piece that I have available there. So in one sense, 90% or 0.9 times 7%, this is going to give me basically 6.3. Okay? Do I follow that? Now, if I take 10% or 10 minus 6.3, that means this has to be 3.7. Does that make sense? Okay, in other words, 10 minus 6.3 gives me 3.7. But that's not the answer. That's just simply what is 10% times, that should be times, not plus, times the return on equity. Okay, so what we got to do is now back solve, taking 3.7 and dividing it by 10%. And what do we get? 37%. Okay? Now, let's put some dollars to this for a second, okay? Just to kind of illustrate what's going on, okay? Now, let me make sure that we're clear on this before I actually put the dollars to it. So what that means is that for every basically dollar that I put into this particular deal, I'm going to be getting back basically a 37% return or 37 cents on every dollar each year. Does that make sense? So in essence, really over about 3 years, we're going to fully pay back our equity, would be another way of looking at that. Because if we're getting 37% a year, 37 times, let's say 3, or a little over 3, you're gonna easily be paid back, to my point, within 3 years. Okay? I'm just doing some relatively simple math just to kind of illustrate the concept. Now, in this particular case, before we go on and we put the other numbers to this, let's just sort of change up the scenario just a little bit so you can kind of see the effect of this. So we keep the project rate of return at 10%. But let's change the leverage a little bit, okay? Let's go down a bit with our financial leverage. Let's go down to maybe only borrowing 50%. Okay? Our cost of debt, for the purposes of this example, are going to stay the same at 7%. Our equity percent is now going to be 50%, because we're putting in 50% debt, 50% equity. Okay? But when we go to solve for our return on equity, okay, now without doing the math, just kind of think about this conceptually. Do you expect that our return on equity is going to be higher, lower, or the same?
Lower. Lower.
It's going to be lower because we're getting less financial leverage. Okay, so let's just see. So in doing this math, 50 times 7% is going to be 3.5. Yep. Okay. 0.5 or 50 times 7. Yep, 3.5. And then over here on this side, 10 minus 3.5 is 6.5. 6.5 divided by 0.5, 13. Okay, so by borrowing less money, okay, in other words, less debt, we have decreased our rate of return on our equity from 37% down to 13%. Okay, is everybody cool with that? Yes? Okay, any questions about that so far? Okay, let's take it one step further to illustrate my point from earlier. Keep our overall project return at 10%. Now, in this case, let's say that we go down to 0%. Debt, 0% debt, all equity. Okay, so if we do the math there, well, that's going to be 0. Okay, you can already figure out the answer here, but just go ahead and go forward with the math. So that means 100% equity. And if we do the math here, 10 minus 0 is 10. 10 divided by 100%, 10%. Okay, so it's a no leverage deal. Okay, that just simply means we're not borrowing any money whatsoever, therefore we have no interest expense. Okay, and we're putting in all equity, 100% equity, and so backing into that, our project return or our return on equity is going to be 10%. Okay, everybody cool with that? All right. Now let's take it a step further. All right, so 10% is the project return. All right, and so let's just go back to a situation of where we've got 90% debt, but let's say that we change our cost of borrowing. And let's say that we just increase our cost of borrowing from 7% to 11%. Okay, let's see how that impacts us. So that means we would have 10% as our equity, and we need to solve for, in essence, what our return on equity is going to be. Okay, so let's start off with the 90% times 11, so it should be 9.9. Okay, 10 minus 9.9 is simply 0.1 divided by okay, and we end up with what?
1%.
A 1% rate of return. We're barely making any money. And the reason why we're barely making any money is because pretty much all of the project return is being eaten up by this additional cost of borrowing of 11%. Does that make sense? We're still getting something, but not much. Okay? So if you, once again, kind of continue on and sort of think about the math, if that cost of debt goes up another %, we're going to be losing money. It's not going to be a 1% return, it's going to be something negative. Okay, does that make sense? Okay, any questions about this so far? Okay, now, in my mind, this is probably, if not the most important, probably easily the top 2 or 3 most important things to be able to understand as it relates to investing in real estate. Because it's one of the few types of assets that you can purchase with this much debt and be able to, in essence, generate this sort of positive return and, in essence, control assets much greater than what you've actually put in. Think about it like this. Let me twist it a different way. Let's say that we've got $100,000 that we can, of our own money, equity, that we can put into a deal. Okay? If we've got $100,000 of equity that we can put into a deal, we could go, let's say, buy one asset, like a house, let's say, for $100,000, pay all cash, buy that house, rent out the house, and earn whatever rate of return we can on that one singular $100,000 house. Yes? But if we can go to a lender and we can borrow 90% loan-to-value ratio, that means we can use that $100,000 and borrow $900,000 and control an asset of $1 million. Does that make sense? Okay? And so it's that control. If you think of it, you know, from the standpoint of $1 million, we could in essence buy 10 houses, okay, instead of just one. If we're talking about $100,000 houses, we could buy 10 of those and control 10 houses instead of just owning one. Now the downside to that is, what if those houses stop performing, you know, in terms of the rate of return that they're throwing off, and you actually start losing money? Then you're going to start losing a lot more money, potentially, than you would have lost. You wouldn't have really, you know, in the sense of an all-equity deal, you simply wouldn't be getting a rate of return. You know, if you just simply bought the house for $100,000 and it stops generating rent, you're not really going to be in all that bad of a situation because it was all your money. You don't have to worry about paying anybody back. You don't have any other real costs other than maybe holding costs that you've got to deal with. So from that standpoint, you know, it's a much less risky proposition to just pay cash and own the asset outright. But whenever you start leveraging, you know, the upside is amazing, okay, in terms of you know, the growth of your personal wealth and the growth of the control of the assets that you are able to have and to be able to in essence manage and hopefully over time those assets pay off, and then your $100,000 investment grew to something much, much, much greater very quickly. But on the flip side, if the performance of that asset or those assets doesn't meet the expectations that you go into it with, there's a very good chance you could lose everything and obviously that much more, okay? Does that make sense? Okay, any questions on any of that?
So, in managing the project rate of return, essentially means stabilizing the NOI,
Yes.
maintaining the costs down, and so on and so forth, the liberation of the project.
Yep.
Make sure that you're getting the maximum return against your leverage percentage.
Yeah, and see, this return over here is independent of, obviously, how the project is financed, okay? This is, in essence, you can look at it as just simply your cap rate rate of return, because it's pretty much based on net operating income divided by overall project value. All right? And so it's where you introduce basically your financing structure that then, that may make the difference between, you getting obviously a 1% rate of return all the way up to, in this particular example, a 37% rate of return, just depending on how you choose to structure your financing. And this is one of those sorts of things you have control over, or at least to a certain extent you have control over, in terms of finding a lender. A lender, once again, can be defined as not necessarily just a traditional bank. It could be a high net worth individual that is simply looking to place their money somewhere and get maybe a fixed rate of return. Okay? So, stop thinking of lenders as necessarily, the traditional bank that you walk in their front door and you sign a bunch of paperwork and you get a loan from. It could very easily be just simply a high net worth individual that's able to in essence, loan you the funds to be able to do a project. Because in a lot of cases, a lot of these high net worth individuals, they don't want to have to deal with the day-to-day sort of operations of a property. In many cases, they're simply willing to say, here's the money, go do the project, and at the end of the year or end of the project, simply give me back some sort of a fixed rate of return, and as long as you meet that return, everybody's happy. Okay? All right, moving forward. But let's put some numbers into this, because I know that some of you would love to see some numbers affiliated with this. So let's just sort of take this first one here for a second. Let's just do it here on the board if I can. All right, so we sort of said, all right, we've got a project. Let's say that it's $1 million project. So $1 million is the total value of the project. And if it's generating a 10% rate of return, then that means it's generating $100,000 a year of net operating income. Okay, does that make sense, everybody? All right, so $1 million project, 10% rate of return is $100,000 net operating income. Now, if we go back and we simply put in, instead of the rate of return here, we simply put in $100,000. Okay? That's the dollar amount of the rate of return. And then we go over to the debt. Okay? In this case, the debt, or the loan to value, is going to be 90% of this. All right? Or $900,000 of debt. Okay, so we write that in up here.
Head north on Southwest 75th
All right.
toward Southwest 30th Street.
Now, our cost of debt in this particular case is going to be 7%. Now, this model, because of its simplicity, assumes an interest-only sort of mortgage, okay? But our cost of interest on an annual basis is $63,000. So our interest cost is $63,000 a year. Okay?
What is the INT? I'm sorry.
Interest expense. Okay? Now, our equity, in this case, our equity is going to be the 1 million times 10%. Just happens to be the same as the rate of return, but that's not, these two are not the equivalent. Don't confuse it. All right? $100,000 is our equity. Okay? And in this particular case, right here, $100,000 is our equity. And a 37% return on that equity each year would be $37,000. Okay? Okay. Now, the thing that you should begin to sort of pick up on what happens when you add the $63,000 cost of debt to the $37,000 return on equity? What do you get? $100,000. Okay, does that make sense? So all I've done here is just simply put the numbers with respect to the dollar amounts, okay? Using the formula, you've got to use the percentages, but in terms of just sort of seeing what those percentages may relate to in an actual example, I put the numbers up there so you kind of get a perspective. So once again, the 37,000 plus the 63,000 equal the overall project rate of return. Does that make sense, everybody? Yes or no? Okay, and then this is just somebody telling you you've got $900,000 of debt, $100,000 of equity. Okay, everybody cool with that? Any questions? Okay, moving forward. Okay. Some of this is going to be a little bit of a review, simply because of just what happens to be in this particular chapter. Okay. Loan to value ratio. One of the things that a lender, once again, whether it's a traditional lender or it is someone that, once again, a high net worth individual, institutional investor, whoever, normally one of the first things that they're going to do is to say, okay, they're going to set some sort of a loan to value ratio for any sort of a loan that they make to you. Now, how that loan to value ratio gets set is dependent really on kind of what the lender chooses to do. Now, as a sort of a normal matter of practice, in really strong economic times, typically the loan to value ratio is higher. And what that means is that signaling on the part of the lender that they have confidence in the underlying value of the asset and its ability to generate income and their ability to be paid back. In weaker economic times, or associated maybe with a particular property or property type, they may say, we don't really have a whole lot of confidence in this particular property or in this particular market or this particular sort of point in time in history because of all different sorts of things that are going on. So we're going to basically set a much lower loan to value ratio, meaning that you're going to be able to borrow less, okay? Because they don't have as much confidence that that underlying value of the property is really maybe sustainable, or that the ability for that property to generate income, you know, on a long-term basis may be inhibited in some way. Or it could just be it's an area of town that has poor economic conditions, and the lender is just simply saying, we're trying to hedge our risk here, and we're not, you know, willing to lend here simply because we don't think it's once again a strong enough economic, you know, sort of environment for the property to be able to make its debt service payments. Okay, does that make sense? Okay. Now, so let's say that we've got a property and we've valued this property at $5 million. Okay, so $5 million overall value. And let's say that the lender has set a maximum loan-to-value ratio of 65%. Okay? So, very simply, what would be the maximum loan amount that we could potentially obtain from that lender? You're simply going to multiply the 5 million times the 65%. So $3,250,000 is going to be our maximum loan amount. Okay? Meaning that the remaining 35% is going to have to come from equity. Okay? Make sense? Any questions? Okay? Now, in terms of equity, up to this point, we've pretty much tried to keep it fairly straightforward in the sense you have one investor, one source of equity, and that's pretty much how things are running. And in most relatively simple, straightforward deals, that may be the case. But what we're going to be doing a little bit later is to sort of, well, what if maybe our lender potentially becomes an equity participant? Or what if we take on equity partners? How does that begin to potentially complicate things? And so we'll deal with that a little bit later, but right now, we're keeping it fairly straightforward. All right, moving forward. Now, one of the other key things that lenders are going to take a look at is our debt service coverage ratio. We've talked about this before as well. All right. So in addition to the loan-to-value ratio, one of the other things that a lender is going to typically set is this debt service coverage ratio. Well, the debt service coverage ratio is equal to the net operating income that the property is throwing off on an annual basis divided by the total annual debt service associated with that property. Okay? Now, just to kind of refresh you a little bit, we think about our typical property, we've got potential gross income, subtract out vacancies and collection losses, we get other income, that is going to give us effective gross income, we subtract out total operating expenses, that gives us net operating income, and then we subtract out annual debt service, and that gives us before tax cash flow. Okay? Well, if you sort of take a look at what the lender is concerning themselves with, net operating income and annual debt service, okay? So what they're really wanting to make sure for whatever property that they're going to lend you money on, that in essence, there's going to be sufficient net operating income to pay back whatever debt service is associated with that property. So in other words, you're always going to want your net operating income to be greater than your annual debt service because you want a positive before tax cash flow, or from the lender's perspective, you want to ensure that you're going to get paid back. Okay? Now, if the lender were to simply set a 1.0 as the debt coverage ratio, they would never do that. Okay? But assuming they did, what that's basically saying is that let's say that we've got $10,000 that we have calculated as our net operating income, and the lender is willing to make us a loan where our annual debt service happens to equal $10,000, and that leaves us with a before tax cash flow of 0. So in other words, we're simply saying 10,000 divided by 10,000 is going to give us a debt service coverage ratio of 1. Why would the lender not want to do that?
Because there's no cushion.
There's no cushion. In other words, there's nothing left that in the event that you potentially, in some way, screwed up, you know, with the net operating income, you know, that potentially vacancies were higher than you expected, expenses were higher than you expected, you know, you didn't generate maybe as much other income as you had anticipated, you know, all of that will flow through, obviously, down to the net operating income. And so what that would mean is that if anything goes wrong, the lender potentially is going to be left in a situation of where you may not be able to pay them back. Okay, does that make sense? All right, so they're pretty much never going to give you a 1.0 as a debt service coverage ratio. The best that I have personally seen is about a 1.1, 1.15, okay? Most historically have been around 1.2. A lot of projects now typically 1.3, 1.35, okay? Yeah.
I'm just curious, why was that one project so low?
It was because you had a borrower that had immaculate credit and a tremendous amount of net worth,
Oh, okay.
or like an institutional player.
Okay, so there's pretty much not any risk.
Right.
So that,
They're going to not get paid back.
yeah.
Okay. Now, so if we just assume here for a second that 1.3 is going to be the debt service coverage ratio. All right. So if that's the case, and we have our annual debt service maybe staying constant at 10,000, then what does that mean our net operating income needs to be? Just work backwards. So what we're saying is that if we have a required debt service coverage ratio of 1.3 and our annual debt service is kept constant at 10,000, what does our net operating income need to be? 13,000. Okay, so in other words, 13,000 minus 10,000 would be 3,000 in terms of actual dollars, but in terms of the debt service coverage ratio, it would be 1.3. Does that make sense? So there's a 30% cushion, is the way to look at it percentage-wise, or in terms of dollars for this particular project, a $3,000 cushion. So that simply means that, yeah, our net operating income could go down, theoretically, in practice, by $3,000. The lender is still going to be paid, but, you know, having just said that, historically, whenever you've obtained a real estate loan, the initial debt service coverage ratio was what the loan was based on, and it just simply, once you got the loan, you got the loan, you made your payments, you know, for however many years over the course of that loan. If you missed a payment or whatever, then the lender stepped in and potentially, you know, in some way try to extract that payment, that sort of thing. But what has begun to happen in many commercial loans within the past few years is that instead of that whole thing of you know, once you sort of walk in there and once you get the loan and you walk away and never have to really almost see the lender again except to give them a check every month for the mortgage payment, now many lenders are monitoring or are requiring that you provide them documentation on a regular, ongoing basis, whether it's in real time in the sense of they have access to all of your accounts affiliated with this property, or it's like a monthly statement, or it's a quarterly statement, or an annual statement. And any time that maybe your debt service coverage ratio drops below a certain amount, then they will potentially step in and say, okay, what happened here? Why did it drop below a 1.3? You know, and potentially, depending on the reason, like for example, you probably lost a tenant. Okay, well, they're going to be a bit more interested now in you replacing that tenant, but not just replacing the tenant, but also making sure that you get a high quality tenant. Okay, to actually, so in some cases, what may happen is the lender will have not only that requirement that you meet the certain debt service coverage ratio, but also they are going to have sort of an approval process that any new tenant that you want to introduce into the property, they've got to sign off on, okay? In terms of the quality of that tenant, in terms of the cash flows, you know, making sure that they're going to be certain. And so this brings up a really interesting dynamic in real estate lending that's emerged over the past several years. Historically, the loan was made to, let's say you, the borrower, okay, based upon your credit history, based upon your sort of financial footing and foundations, okay? But now, with a lot of the commercial loans, the lender is saying, I don't really care so much about you and your sort of personal sort of background. What I care about is who are the tenants within the property, because they're the ones that are actually paying the bills, okay? So, you know, you may have a great credit history and a, you know, overall, net worth is incredible and you own a bunch of properties. That's wonderful, but what I am probably going to be more concerned with in today's market with respect as being a lender is who are all the tenants that you have in place? Are they high quality tenants that have, you know, good track records in terms of their performance? Does that make sense?
Creditworthiness.
Yeah, the creditworthiness of those individual tenants. And so I may actually be making the loan really more on behalf of the underlying tenants and almost ignoring, to a certain extent, you know, the actual borrower.
But how do they do that? Are they evaluating selection criteria of the client?
Yep. They're pulling basically the credit reports of the actual tenants, okay? And, you know, for commercial tenants, it's not the same as like your personal sort of credit score. They're pulling sort of Standard & Poor, Moody's, and, you know, a handful of other sort of basically organizations that collect information about, does this particular commercial tenant, do they pay their bills on time? Do they, you know, have they ever had a late payment? You know, very much the same kind of criteria that gets applied to you as an individual, but is applied to basically these individual commercial tenants. And so, you know, it's an interesting shift because then you kind of begin to get, as some lenders have begun to do, is to say, okay, we're going to set the interest rate for your loan based upon the quality of your tenants. Well, does that not make sense? But if you really want to get it, you know, and parse it down to, I don't want to say it's the absurd, but in my example, it's going to seem like it's sort of absurd. But let's just say that we've got, you know, here 5 different tenants, okay, and each one of them, you know, has a different, you know, sort of story and a different situation. You maybe have one of them that has immaculate sort of credit history as a tenant, but then you have another one that is lousy, okay, and then another one that's maybe average, and another one that's, you know, once again, really great. And the lender could sort of say, okay, especially if we're talking about retail tenants, you know, sort of say, space 1 is going to have effectively a really low interest rate attached to it because it's a really high quality tenant. Space 2, not so much, lower quality tenant, you know, potentially much higher interest rate attached to that, and so forth, so on. Okay, does that make sense? In other words, you're like condominiumizing, if you will, basically each of those loans. Much the same way that you might, in a traditional sort of residential condominium, have different rates depending on the quality of the credit histories of those tenants. You're now beginning to apply that same sort of methodology to commercial tenants. Good question?
No, you're going to divide the tenants, right? In the same loan.
Yeah, so you could very well have sort of 5 different components to the loan, maybe 5 almost mini loans to a certain extent that the rate could fluctuate depending on the quality of those individual tenants. You know, it's a question of how far you want to kind of push this as a lender, because part of it, you know, kind of comes down to traditional lenders, you know, didn't really have the technological infrastructure to deal with those kind of complexities. You know, they simply said, we're making you a loan based on the overall net operating income of this property with this, you know, very simple sort of debt service coverage ratio. End of story. We want you to make your payments from, you know, for now, for the next, you know, however many years you have this loan with us. See you, bye-bye. Just give us those monthly checks. But given at least two things, if not more, lenders have changed their behavior. One is the impact of technology. Okay, the ability to extract that sort of information has become incredibly easy and almost costless. Okay, and so they're saying, okay, if it's easy for us to get and it doesn't really cost us any money, and all of it can be handled almost, you know, through artificial intelligence in the sense of if there's something that pops up that's unusual or out of the ordinary, we're going to be alerted. Then the lender is saying, okay, that makes sense for us to take a look at. The second, you know, reason is given that we have had, you know, over many years, you know, the whole up, down, you know, in terms of market cycles, lenders have become, you know, a bit gun shy, you know, as to what may actually be taking place within a market. And just because that wonderful tenant that you put into place 5 years ago was doing incredibly well, maybe 5 years later, not so much. So the lender is saying, we want an early warning system so that we can protect ourselves and that we don't end up getting into a situation of where effectively the property goes belly up because we weren't really paying attention to how the property was actually performing. That if we could start to see, yeah, this tenant is starting to pay late, they're not paying as much as maybe they used to be paying because of maybe a percentage rent, you know, there's some other things, you know, sort of going on there, and the lender's picking up on that in terms of their surveillance, if you will, of that particular loan, then, you know, that would allow the lender to potentially intervene and say to the borrower, what the heck is going on? You know, and trying to figure out, you know, very quickly whether or not, you know, there's something that they need to even take a further step and say, all right, you haven't been doing a great job managing this property. We're potentially going to step in as the lender and take that management function away from you, okay, and, you know, call that a technical default, not necessarily an actual default, but a technical default. And I've used this term before because it's a really important term from the lender's perspective and the borrower's perspective. An actual default on a loan is where you stop making a payment, okay, or you miss a payment or payment's late, you know, that is an actual default, okay? It occurs, you know. A technical default is one where you as the borrower don't meet some sort of a threshold of responsibility that the lender has placed upon you. An example of that would be that the overall debt service coverage ratio on the property falls below a 1.3, okay? Or your occupancy level on the property drops below 85%, or something like that, okay? And if the lender sees that, they're saying, okay, technical default, then that gives them, by virtue of the loan documents, the right to potentially step in and take corrective action, okay? It's kind of like, as long as everything is going okay, they're going to leave you alone. But in the moment that something starts to look a little fishy, they're going to potentially step in and exert control, and the extent to which they exert control, you know, is going to be dependent upon, you know, the circumstances. Okay, does that make sense?
Lenders are going that deep.
In some cases, yes. And this is what I'm saying. This is, in my mind, this is the evolution that we're seeing with lenders. You know, is every lender performing that way or handling the situation that way now? Absolutely not. But are many lenders, you know, doing this already? Yes, they are, especially in the commercial mortgage-backed securities market. Okay, because, and we're going to talk about that later. But the point is, there's a lot of oversight that those lenders, you know, constantly are reviewing. Like, for example,
checking the leases, the terms, everything.
Yeah. Well, I mean, like right now, I mean, think about, like, who are two of the major retailers that are in crisis mode right now? Sears and JCPenney's, okay? You know, and many of the articles, if you've read them over the past, you know, just even few months, they're pretty much saying this is probably the last, quote unquote, holiday season that both of those retailers may see, simply because they're both in financial dire straits. Sears would have probably been out of business a few years ago had they not had basically, major cash infusions from this, you know, sort of hedge fund that were, you know, giving them loans, whereas JCPenney's doesn't really have that deep pockets. So there's a very good chance that both of them are probably going to go out of business. Well, it's interesting. Sears traditionally owned the real estate under most of their stores, okay? And that was one of their biggest assets. And now, I think, you know, I'm not really 100% sure, but I think a lot of that has been sold off, and there may be still some left. But I guess my point with this is, what if you were the lender that potentially had the loans for stores like Sears and JCPenney's? And maybe those loans were made 10 years ago. Would you not be a little worried right now that you're going to get paid back? So would you not potentially want to maybe step in and say, hey guys, the show's pretty much over, we probably need to sell off these assets while there's still some value there? Because we don't want to be, as a lender, left holding the bag with nothing in it. Does that make sense? So that's what I mean by this, is that there's going to be a bit more due diligence or surveillance or, you know, looking for those kind of circumstances on the part of the lenders. Okay? All right, but not every lender. Okay, moving forward. Okay, so this next piece, all right, let me finish up with this one here real quick. All right, so let's say that this particular property is generating $13,000 of net operating income, and we have this debt service coverage ratio of 1.3. That means that our annual debt service is $10,000. Now, what if I said that the loans that were available from this lender were at, give me an interest rate, 7%. 7% interest rate for how many years? 20 years, okay? Now, what I want you to do is to figure out what is the actual loan amount based upon that annual debt service. Now, more than likely, I'm going to want you to calculate it based on the monthly debt service. So you're going to have to divide the $10,000 divided by 12. And that's going to give you a monthly payment of $833.33. Okay? So if we simply take 12 payments per year, and we put in $833.33 as the payment with a 7% interest rate for 20 years, what is the maximum loan amount? We'll be solving for present value.
$107,000.
So the maximum loan amount for this property would be $107,484.99, or 45 rounded. Okay? Does that make sense?
It's the max loan amount.
Max loan amount. Okay? All right. Moving forward. equity participation loan. Anybody have any idea what this is? Okay. So you may have a lender, once again, think non-traditional lender, just simply think, once again, a high net worth individual, other sort of player in the market. And they basically say, all right, we're willing to make you a loan. And we're willing to make you a loan with a low stated interest rate, but what we want is a piece of the action, okay, in the property. And by that, they may want a piece of the operating income the property generates in terms of a piece of the net operating income. And they also may want a piece of the upside value in terms of the sale of the property, okay? So in one sense, they're becoming an equity participant within the property. They're no longer just a debt provider or a lender. They're now saying, we're going to loan you this money, we're going to loan it to you at this low stated interest rate, but we want a percentage of your net operating income each year, and we want a percentage of the value increase of the underlying property. Does that make sense? Yes or no? Now, why would you, as a borrower, agree to that? Number one, maybe you don't have a choice, okay? Number two, why would you agree to it?
You get more money.
You might be able to get more money, or you might be able to, you're once again able to borrow at a lower interest rate, maybe even shift some of the risk away, from yourself to the lender in some ways. But why would you not want to do this as a borrower?
Loss of control, loss of equity.
Maybe the loss of control, and certainly the loss of equity side, in the sense that all of the effort that you've put into actively managing this property and getting it up to a certain occupancy level, all these other things, you're going to feel like, to a certain extent, maybe you're being cheated out of some of the economic profits affiliated with the property, just because this person over here or this lender over here is providing you with the money, but they actually have never lifted a finger to actually do anything affiliated with the day-to-day operations, okay? And it's kind of an interesting, dynamic. Anybody that's ever had financial partners in a deal, there's almost always kind of that tension that exists there, because you have the day-to-day sort of operator that's out there getting their hands dirty, doing all the work and getting the property up and ready for occupancy and keeping it occupied and maintained. And then you have this other person over here, or lender, whoever it might be, that in essence is just simply providing the money, but they're not doing anything other than providing the money, okay? And then that tension of, this person over here with the money is saying, look, I want my rate of return, give me my money. This person over here says, well, I've been, working really hard and we're barely, making any money at all, and I'm having to give virtually all of it to you, that sort of thing. So it's an interesting dynamic, but let's work through kind of an example here of this sort of equity participation loan. So let's say that we've got a property, $2 million is the value. All right? And we get, how big of a loan do we want to get in terms of loan to value? Give me a percentage. 90. Okay? So a 90% loan to value. Okay? Let's do the math on that. 1.8. Yep. Okay? So a $1.8 million loan. All right? Now, let's say that so what interest rate? We want to give a really low interest rate, so what?
2%.
2%? All right, 2.5%, we'll compromise. All right, 2.5% interest rate. And in this case, we'll say 15-year term. All right, so basically this is going to become our present value. And initially we're going to solve for the payment. Let's do that. And 12 payments per year. okay? So our monthly payment is gonna be $12,002.21, yes? Okay, so that would ordinarily be, you know, the lender's cash flow. However, we're gonna make the assumption that for this particular property, and first of all, let's sort of figure out that payment times 12, just to kind of get us a perspective on what that means on an annual basis. So annual debt service for this property is going to be $144,026.47. So that's going to be annual debt service, okay? Whereas this is obviously monthly debt service. All right. Now, let's say that our annual net operating income is $250,000. That's going to stay fixed. So our annual net operating income is going to be $250,000. That's going to be our annual debt service. All right. Now, in this particular case, what we want to first of all, let's just sort of figure out, well, what's left over. It's about $105,973.53 would be our before-tax cash flow. Okay, everybody understand what we're doing? All right, now, the lender says, I want 25% of, let's say, the before-tax cash flow. They could also say we want 25% of the net operating income above a certain dollar amount. You know, so it could be structured a variety of different ways, but we'll keep it, and for this example, relatively straightforward, and we'll just simply say they want 25%. Okay? This is the sort of the lender participation piece. All right? So if they want 25% of that, that's going to be $26,493.38. So the other 75% we would be keeping as the borrower. Does that make sense? All right? Now, in this case, they're also going to get a certain percentage of the price appreciation, okay, of the property over time. So over this 15 years, we could sort of approach this a variety of ways. We could simply say, okay, well, the property's going to sell for a certain dollar amount, or it's going to appreciate at a certain percentage per year. You could also say that it's going to be based upon the net operating income divided by the cap rate. So we could come at whatever that number is in the future a variety of different ways. Okay, does everybody understand? Okay. Now, so in this particular case, let's say that they're going to use an 8% cap rate to come up with the value at the end of year 15. Okay? And if we're making the assumption that the net operating income is going to stay constant, then pretty much from that point forward, really the value is not really going to be going up. Okay? It's going to be whatever it is based upon the cap rate, but it's not going to be going up anywhere beyond that. So let's just see what that would actually even be. So $250,000.
It's at end of year 8, you said?
15.
Oh, 15.
So $250,000 is our NOI, okay, divided by the cap rate of 8% means that we would have a value, let's see what that gives us, of $3,125,000. Okay, that's what we would sell it for at the end of year 15. Everybody understand that? Because our NOI is not going to be going up, it's going to be fixed, so, but that's what we're going to sell it for, $3,125,000. Now the lender, they want a piece of that as well, okay? And so, excuse me, above and beyond what you initially paid for it, well, if you paid $2 million for the property, then the increase in value was $1,125,000. So in other words, that is the property appreciation. Okay, does that make sense? Now the lender, let's say they want 25% of that. That would be $281,250. Okay? Now you're starting to see what this thing is doing. It's stacking up as a cash flow problem. Okay? So, let's just sort of think about this for a second. How much is the lender giving to us at time period 0?
2 million.
90%.
They're giving us 1.8 million. Yes? Okay. How much is the lender receiving each month? Well, that's where it gets a little tricky, because the annual cash flows are really going to be the annual debt service. They're going to be receiving that, but they're also going to be receiving this equity piece, okay, of 26,000. So in essence,
So in this instance, they're receiving both 25% of the before tax cash flow and the,
debt service.
okay.
So let's just sort of take a look. All right. So at time period 0, we're going to make the assumption now this is going to have to be on an annual basis, simply because that's how our data is given to us. Oh, let's see, 1 period per year. Okay, we're going to have 1.8 million as our cash outflow for the lender. And then for the first year, they're going to get $144,026.47 as their annual debt service, plus they're going to get the $26,493.38. Add those two together, and then that will be the cash flow that they're going to receive basically each year for the 15 years. Does that make sense? Okay, but, in the final year, the lender is also going to receive what? They're going to receive the $281,250. So what you're going to do is you're going to make the assumption they're going to receive this for 14 years. So the 14 shift N sub J, and then in that 15th year, they're going to receive the 144,026.47 plus the 26,493.38 plus 281,250 equal as the final cash flow. And then we're going to solve for basically what is the internal rate of return. In other words, their cost to borrow, or what is the lender's yield. Does that make sense, everybody? Yes? Okay, so let's do that real quick. Okay, what I ended up with, 5.79%. Okay? Now, think about this just for a second. What was the interest rate on the loan?
2.5.
Okay? 2.5% interest rate, so they're more than doubling what their sort of stated rate of interest was, simply because they're capturing some of basically the equity, okay? In terms of getting a percentage of the net operating income and getting a percentage of the ultimate price appreciation in the property, okay? Make sense? Okay. All right. Moving forward. All right. Sale leasebacks. These can take on a variety of different forms, but probably one of the most common and I guess useful is where you have a retailer. Doesn't have to be a retailer, it could be office tenant as well, or office park user. But they want to build their own property, okay? They want to find their own space, okay? And so the most probably common of these is like with Walgreens stores and CVS's and sort of, you know, traditional sort of retail box kind of tenants. But they want to go out, they want to find their own location because they know what they're looking for. They want to build their own building because they know what they need, they know, you know, specifically what their conditions are. But then once they've got it built, and once they've got it occupied, they want to basically sell it, okay? And the reason they want to sell it is to get that debt off of their books that frees them up to potentially invest in more properties and expand. But they also have another reason for wanting to do that. And that is, they want to be able to capture the economic profit that maybe they have been able to generate as a result of actually developing this particular property, okay? Because what they're going to be doing is they're going to be selling it to a third-party sort of player that in most cases is a high net worth individual or some sort of an institutional investor that is looking for nothing more than a check in the mail, okay, every month. And as we had talked about previously, in most cases, these are going to be absolute triple net leases, meaning that the tenant is going to be responsible for everything. The owner, the landlord, is responsible for nothing, okay? If something breaks on the property, it's the tenant's fault, or it's the tenant's responsibility. Okay, does that make sense, everybody? All right, so let's just say that we have this kind of scenario where you've got the Walgreens, they come in, they find a site, they build their building, put in their parking lot, everything, and maybe the whole cost of doing this is, let's say, $8 million. It's total acquisition of the land, total building of the building, everything, all inclusive, $8 million. But what they can do is that after getting the building built, after occupying the building, they can immediately sell it for $10 million. Okay? And then lease it back from whoever it is that they sell it to. Now, in most cases, these leases are going to be really long-term leases. Usually, you know, going to be 20, 25, 30-year leases, all right? And so once again, whoever, you know, buys this from them, they're just going to be getting that check in the mail just like clockwork, okay? No issues, no problems, no fuss, no muss. Now, right off the bat, as I said earlier, one of their motivations is just that. To go from having, you know, gone in, bought the property, developed the site, and everything all in cost are $8 million, well, instantly, if they're able to flip it for 10 million, that's right off the bat, they've made a 20% profit. Okay? Does that make sense? Well, think about it. What can they do with that profit? Well, they can put that into that store if they want to, or they can put it toward their next project. Or make whatever other choices they want to make. But it's a nice cash infusion, I guess is my point. Okay? Now, so in this particular case, let's say that you're going to do a 25-year lease. And let's just figure out what your lease payment might actually be based on this. So we've got, once again, 12 payments per year, let's say. And let's say that the lease is based on a $10 million value. 25 years. And then this is kind of the part of the key of this is, well, what is the return that these folks that have just bought your building for $10 million, what return are they seeking? And usually it's not a big return. You know, it's like 3 to 5%. I mean, so let's say 4%. 4% return, all right? And then we figure out, well, what is that lease payment going to be? Which is very much like calculating a mortgage payment. But in this case, it's a lease payment. Okay, on a monthly basis, it's $52,783.68, okay, on a monthly basis. Now, if they've made a $2 million profit, let's just kind of do some simple math. This is a good example of a problem. If they've made a $2 million profit on this, how many months could they operate without having to really dip into their bank account other than the $2 million profit they made on the sale of the asset? You follow what I'm asking? Yeah. If their lease payment's $52,000 a month, how many months, in essence, could they operate? So you would simply take the $2 million divided by 52,783.68. Okay. Yes, 37.8 months. So what that means is they could basically occupy the property for a little over 3 years without ever having to make a lease payment, above and beyond what they had captured from that $2 million profit. Okay, now if you think about the value of that, well, you know, it's a new store. May take a little bit of time for it to obviously get off the ground and be generating the kind of revenues it needs to generate, but that gives them a nice cushion, you know, for 3 years. Not that they're going to need to do it that way, but that's just one way of kind of looking at it. Does that make sense? Okay, any questions? Okay. All right. All right, interest-only loans. All right. Excuse me. All right, so let's say that we've got a loan for $5 million, and we have an interest rate of 10% with monthly payments. Okay? Now this is an interest-only mortgage or interest-only loan, and we've talked about this before, but just, you know, slightly different context. So in this case, if I were to ask you what is the monthly payment for this, you can simply take the $5 million times 10% divided by 12. $41,666.67 would be the monthly payment on an interest-only loan or mortgage. Okay, everybody cool with that? Now, what's going to be the payment in month 12?
times 12.
Oh,
The same.
the same.
The same payment,
Yeah, it's gonna be the same payment regardless of what month it's in. Okay, it's a trick question, all right? What would be the payment in, you know, month 180?
Same.
Okay, it's gonna be the same. Okay, moving forward. All right. Let's skip over accruals and come back to that. We're gonna do convertible. It's a real simple one. All right, convertible mortgage. This is where, very simply put, a lender can potentially buy into an existing loan, all right? And they can, in essence, convert that loan from being debt to being equity, okay? That's why it's called a convertible mortgage, that it basically goes from the lender being your debt provider to all of a sudden at some point, if the lender chooses to do so, they can say, now we want to be an equity player within this deal, okay? And they have the right, but not necessarily the obligation to do this. In other words, it's an option for the lender. And now you're saying, okay, well, under what circumstances might the lender sort of opt into this? Well, let's say that we're sort of rocking along in this property, everything is going very smoothly, and the lender has sort of, you know, set this up to say that, all right, you know, at the end of 5 years, you know, I've got the option basically of becoming an equity player in this deal. Now, as to when they have to exercise that option, you know, that's all, once again, sort of paperwork in terms of when they have to declare it, okay? It may be they have to declare it, you know, within the first year, or by the end of the 5th year, or whatever, but at some point they say, we want to be an equity player. So, what that means, and they may have to pay extra for that right to convert, but not necessarily. It could just be that is simply one of the options that's available to them. But, here's my point. So we're rocking and rolling, you know, for 5 years. The lender sort of says, you know what? This property has really appreciated in value over this past 5 years. Instead of just simply taking the return that I have generated off of the interest payments on this loan, I want to convert this thing over. I want to be a partial equity player in this deal. So I'm going to pay maybe a whatever, you know, a fee to the borrower to do that, and it could be a very nominal fee, it could be a very substantial fee. You know, but once again, all that's in the loan documents. But what it entitles the lender to be able to do is to essentially say, when this property gets sold at the end of 5 years, I want a piece of that. You know, and I want, and this is the amount of the piece that I want. I want 50% of the price appreciation of the property. Okay? Now, once again, you have to ask yourself the question, why would you do this? We kind of go back to those, you know, sort of original, you know, reasons we gave earlier. You maybe do it because it's your only option. It may be that, once again, this is not necessarily a traditional lender. This is, you know, some sort of a high net worth player, and they're simply, you know, looking at this as a situation, as long as everything is going okay, I'm really not going to step in, but at some point, if I choose to do so, I have the right to do so, and potentially, to a certain extent, take away a good amount of the economic profits that may have been generated off of the value of this property. Does that make sense? But this is a lender's choice kind of thing. All right? Moving forward.
They can also force an early repayment.
Yes, they could also,
Take over.
that is true too. They, potentially, if, once again, if certain conditions are not met, the lender could say, we're going to require you to pay off the loan early.
Which forces you to essentially.
Yep, sell the property. Okay, mezzanine loans. Mezzanine loans, or mezz financing, as you sometimes hear it called, this is where you have more than one layer of financing. You potentially, you know, we have our equity that we've put into the property. We have the debt that we're borrowing on the property. But then we may have an intermediary sort of piece that we call mezzanine piece. Now that mezzanine piece could be pretty much purely debt, could also be sort of purely equity, could be a blend of the two. Now, those of you that maybe had any sort of, finance background, in finance they talk about debt and equity, and then they talk about common stock that you may have within a company, and they talk about bonds that you may have within a company, but then they also talk about something called preferred stock, okay? This is very similar to that. I mean, in essence, it's another sort of hybrid-y kind of form of debt or equity that you're able to sort of take on. Now, the word mezzanine, you're sort of like, okay, sometimes you wonder where these terms come from. It means sort of a middle layer. And in a lot of hotels, if you kind of remember, many times, especially the older hotels, you would sort of have the ground floor, and then they would have this sort of middle floor they would call the mezzanine level, okay? And it's just kind of, to basically distinguish between it being the ground level and kind of something before you go up into the actual rooms of the hotel. But they typically refer to that as the mezzanine, okay? Well, it's all it really means. It's sort of a middle level, okay? Now, for our purposes, we may have a situation where we want to find out what our overall cost of borrowing is on a property. And we can actually kind of go back to our little formula that we had earlier, where we had debt, we had equity, and then now we're going to add into that mezzanine, okay? So instead of there being two sources of financing, there are going to be three. So our debt, let's say, is going to be 80%. Now, what that means if debt is 80%, then the remaining 20% is going to be split in some way between equity and the mezzanine. Okay? So it could mean, I'm just going to sort of throw this out, well, if we simply say that our equity, we're going to require a 5% equity investment, then what does that leave for the mezzanine? 15. Okay? And in this case, if we say that our cost of debt maybe is 5%, and our cost of mezzanine is, let's say, 10%, and our cost of equity is possibly 20%, we could just simply say, okay, well, tell me what the overall rate of return for the property would need to be. Okay? So let's just do that math here real quick. This is going to be 4. That's going to be 1. And that's going to be 1.5. Okay, so we add those three together. Our overall rate of return for this property would need to be 6.5 or higher in order to satisfy the requirements of our debt, equity, and mezzanine. Okay, does that make sense? Now, we could also simply say, well, what is our cost of actual borrowing on this property? And in this case, if that's all we're searching for, then we're going to get rid of the equity piece. Okay, and we're potentially going to look at this from the following perspective. If we've got 80% at 5%, 15% at 10%, overall debt is 95%, and we want to know basically what is that overall cost of borrowing at the 95%. In other words, what is our cost of debt? Okay, not necessarily the equity piece, but what is our cost of debt? So what we're going to do is sort of multiply this out. 5.5 when you add those two together, but you've got to take that 5.5 and divide it by the 0.95. So your actual weighted cost of debt is 5.79%. Okay, does that make sense? So that's just simply taking our two cost of debts in terms of our regular debt and our mezzanine debt and finding a weighted average for those and then working back to what is that actual sort of weighted average cost. Okay?
How did you find that 5.7
Okay. This times this is 4, this
Right.
times this is 1.5. We add those two together, it gives us 5.5. Take the 5.5 divided by the 95%, and then that gives us 5.79. Okay? All right. Almost there. Okay, let's talk about accrual loans. All right. Anybody have any idea what accrual loans are?
Could it be that you're going to accrue the interest rate, or it could be the
Okay.
accrual of the repayment? Anything can be accrued, right?
Is that a negative or is it?
To a certain extent, yes. Okay. Basically, you have two different rates of interest. Okay. You are typically going to have an accrual rate and a pay rate. Okay. So in this case, let's say that we've got a 15-year mortgage, a 15-year loan, and the value of this is $500,000. And we're going to have a pay rate of 4% and an accrual rate of 7%. And what I'm going to want you to do is calculate the outstanding balance at the end of year 1. Okay, so think about what this is. If you're paying 4% interest, but the interest is accruing at 7%, then that means, as you were just saying, Jesus, that you're in essence going to have negative amortization. Okay? So why might a lender do this kind of a loan?
Keep up with inflation?
Yeah, or more specifically, they actually see the underlying value of the asset increasing substantially. And they're willing to sort of cut you a deal on the front end to give you the sort of lower rate of interest, but yet what they're really saying, though, you're going to owe us more than that whenever this loan comes due, because it's obviously accruing at a higher rate of interest than what you're actually paying. Does that make sense? Okay, so let's just see if you can do it. All right, 12 payments per year, 500,000, 4%, 15 years, get the payment. Payment of $36.98.44. So, okay. Now, what we're going to do is, okay, that would be the ordinary, normal payment. Yes? Okay. But what we're going to do is first of all, we need to figure out the payment for the other. So let's go ahead and do that. We put in 7%. You know, I think this will work. I think if we just simply put in 7%, but we don't solve for the payment, and we simply put in 12 N, and then solve for what is the future value.
Is the 4% increasing by 7%, or is it just turning into 7%?
So the accrual rate, in other words, it's turning into, in other words,
Throughout the length of the term, the 4 will
you're
turn to 7?
You're making payments based upon the 4% rate.
Right.
But what's happening is the lender is saying those payments are really not going to be enough to service the loan because we're charging you this pay rate, or I'm sorry, the accrual rate of 7%. So you're going to owe more at the end of the year than what you probably borrowed simply because you haven't been paying down enough.
Okay. So in my mind, I'm thinking that year 2 rate is going to be 4% times
No.
1.07.
No,
That's not the
no,
case.
no. Okay, let's see. 500,000, 4%, 10 years, and okay, 7%, and then 12 in. Yep. So the balance did go down a little bit, but not as much as it would have gone down had we been actually making the full payment. Okay, let's just double check that to make sure that I'm not lying to you. So let's go back over here and just simply put in.
Why is N12 now?
Because
After
we're
1
saying,
year, after
we're
1
saying
year.
after 1 year, what's the balance?
Okay.
End of year 1.
So let's just say that we did 500,000, 4%, 15 years, we get the payment. Then we simply say, what is the balance, assuming we don't change the interest rate to an accrual rate? Oops. Okay, let's see what the balance is there.
We can also do 4% interest rate without future value, sold for future value, right?
475.
475, 166.
Okay, so the balance would have been, if we had stuck with the 4% interest rate and our payment based upon that, our balance would have been $475,000. But because we had the 7% accrual rate over here, our balance went up by about, around $15,000 to $490,000. Okay, because we're obviously accruing more and more interest. Now, as time progresses, we could actually sort of look at this and say, well, what would it be? We went back over here and we say, well, what would it be at the end of the 15 years? So we could actually put in 180 in and solve for future value. Let's just see what happens. So re-put in everything over again, just to illustrate. So you would still owe $252,207.45 basically at the end of the loan term because of that accrual rate being the 7%. Okay, make sense? Okay. Okay. All right, let's do the little quiz.
Back again.
go ahead and obviously put your names on this.